Today in our Lunchtime Stock Club, we're going to take a look at the performance of the year to date. We're going to take a look at the performance of the Investor Advisory Service newsletter. We're going to talk about dividends as they relate to growth stock investing. And finally, I will leave you with a small company idea for your portfolio. Today is December 14th, 2020, the last session of our monthly Stock Club webinars. I'm glad that we made it to December. I think all of us are looking forward to a brighter 2021 ahead. But when we consider the performance to date of the various market segments that I like to track, it's kind of surprising that the S&P 500 so far is up for the year, up 13.88%. The SmallCap 600 has had a great November and first 2 weeks of December, up 6.9% for the year to date, and the EFA index, the Europe, Australasia, Far East index, is up almost 4% for the year to date. So posting a little bit of a recovery there. The small cap stocks have definitely rebounded as the year is coming to a close with news about the vaccine arrival, and as the election uncertainties seem to be resolving somewhat. And we'll see how that all continues to play out. But what a year it's been. That massive decline in March, followed by the subsequent clawing back of the most major market segments, even in the face of pandemic lockdowns and quarantines across the country. If you recall from my webinar last month, I still am looking for recovery to not really put the U.S. back on its feet until the third or fourth quarter of 2021. Everyone's excited that the COVID vaccine is being distributed, but it is going to be on a very slow distribution schedule as it ramps up. And by the time that most Americans will have access to it, it's still going to be sometime in the second quarter of 2021, according to estimates that I've seen, and it's going to take even longer to reach that broader market. Now we've got the first front line of defense in terms of medical professionals and at-risk people beginning to receive the vaccine, but it's still, I think, going to be a very long winter, especially for those of us in the northern and northeast part of the country, where restaurants are really beginning to feel the pinch as holiday travel has increased. The infection rate in many, many states, restaurants we're going into new phases of lockdown. In many areas, we're into a third stage of lockdown, as you know, the refusal of a lot of people to follow the guidelines that have been put out in various jurisdictions and all of the political wrangling that goes on. So I suggest that investors in stocks should maintain a somewhat defensive posture, and we'll see how the year-end pans out. I expect there may be a batch of tax loss harvesting going on, as well as tax gain harvesting for a lot of investors who are looking to kind of balance out their portfolios at year end. So it could be a little more volatile than we have seen in the last few years. But certainly the good news, the stocks have been performing well since that April timeframe, really pretty much jumping back and recovering the losses that we sustained. The S&P 500 PE ratio is at a very, very, very high level on a trailing 12-month basis at 37. You can see where that compares to markets of decades gone by. That PE ratio is high because, of course, a lot of companies in the S&P 500 have depressed earnings. So this is a very optimistic PE ratio, considering investors apparently considering that a lot of the losses and reduced earnings of many large company stocks are going to rebound in the next 12 months. And so they're holding on to those shares So demand is still high for stocks, and that's keeping that PE ratio quite high. You can see the earnings on an estimated trailing 12-month basis continuing to fall off now at just under $99 a share, well off the high that was reached last year. That again reflects the difficulties of a lot of companies in the current pandemic recession, but of course offset by strength from some of the very largest companies that are focused on the internet and online commerce, Amazon, Microsoft, a lot of companies performing well, Google, Facebook, as they're not seeing wholesale losses and declines that many other businesses are seeing. So that kind of keeps it in perspective for us. There are a lot of companies that, of course, are going to be falling off. I wanted to talk about dividends. This is a topic that I've been considering and thinking about. I've often taught classes in the past about stock investing. With respect to dividends, I continue to see in online forums that I occasionally visit, people talking about how important it is for dividends, and there's a lot of misconceptions. And as growth stock investors, we look at dividends a little bit differently than many people in the market. And so I did a little digging and wanted to share some thoughts with you. Of course, as growth stock investors, the Better Investing Toolkit style of investing focuses on total return, and dividends are just one component of total return. Capital appreciation is the key to portfolio performance. We buy stocks, we hold on to them for a long-term period, they go up in price, and then that is the majority of the return coming from that capital appreciation component. But we also like a bargain. We like to buy stocks when they're undervalued relative to their history, when they're at below average PE ratios, or when we can benefit from PE expansion. And that adds to our return as well and can be a significant contributor. As anyone who bought back in March, when the PE of many companies were at all-time lows, would have seen that benefit of stock price performance as the market rebounded and those prices returned to more average PE ratios, seeing a significant return in their portfolios. And then dividends are that third component of return. Dividends are usually paid by mature growth companies, at least that companies that are paying a significant portion of earnings and creating some higher yields. They generally don't tend to make up a large portion of the total return from our strategy, even though, of course, many investors in a total return strategy like this can focus on capital appreciation, focusing on smaller companies, or they can focus on the value component, seeking out undervalued stocks, or they can even focus on the income yield component by looking at stocks that are paying dividends. So you can customize and tailor it as much as possible, but those are still our approach. When we look at the investor advisory service, there are 80 stocks that are followed in the investor advisory service. So those are small, large, and mid-cap stocks. Out of the 80, 45 of them pay dividends. That would have been a higher number than I would have expected before I looked at the data explicitly. But the yields range from 0.3%. Ensign Group is a operator of healthcare facilities. That's the lowest yield, and then of any dividend-paying stocks. And then Gilead Sciences has a current yield of 4.5% on an indicated basis, and that's the highest yielding stock. There are some financial services stocks, banks, and real estate investment trusts that are paying higher yields, and we would expect that. But Gilead Sciences is currently the highest yielding stock. Again, I think it has a lot to do with a lot of negative sentiment about Gilead, even though they've rebounded and performed a little bit better in the last few months. But still, they've had a little bit of a struggle coming from such a high level of success. But when we average out the yield of all 45 of those companies, the average yield is just 1%. And when we look at the median yield, it's just 0.7%. So there are a lot of companies that are paying a slight dividend, but not anything meaningful. Again, 20 years ago, it was not at all uncommon for stocks to start paying smaller dividends or slight dividends because of restrictions that were often in place from large institutional investors, pension funds, et cetera, that had a rule that a stock had to pay a dividend. It was their way of kind of screening out lower quality investments. And so you would see companies paying modest dividends so that that would allow institutional investors to hold them. Those requirements seem to have gone the way of the wayside, but you still have companies paying slight yields, and I think that is meant to at least promote the message that this is a quality company. The yield of the S&P 500, when you look at it over time, and again, this is from multiple.com, going back to 1870, you see that the yield has been on a definite downtrend over the last 150, 160 years for sure. And even since Black Monday back in 1987, that yield has been declining since that point. So at the end of the late 80s, on a fairly consistent basis. You can kind of I'll grab my arrow here and point out some of the interesting peaks and valleys, of course, coming out of 2009, 2010, as the market was experiencing the last bear market. Yields jumped up a little bit. Again, companies weren't coming out of the recession. Companies weren't decreasing their dividends so much, but prices were depressed, and so you see the yield increasing, right? So keep that in mind. And then at the end of 2000s, as we had a huge run up in prices in the 90s, heading into 2000, you see those yields just decline, as PE ratios were very high, so the yields were much lower. But it's interesting that since that point, we've been in this below 2% range on a fairly consistent basis, and the current yield is 1.6% of the S&P 500, and that is really pretty close to where it's been in the last 20 years on a more or less average basis. And this, I think, is really key. In the last 20 years, we have a lot of accumulated wisdom, so to speak, about how the market performs and how to invest that was developed prior to the 1990s, where yields were much higher. The average yield of the S&P 500 over time has been closer to 4%, 4.5%. And that is makes for a very different investing experience than right now when yields are averaging 1.6%. A lot of this has to do with companies shifting their corporate policies to stop paying so much in dividends and use their excess cash, their retained earnings, to repurchase shares. And you'll hear companies referring to how much capital they're returning to shareholders by buying back shares, which does have the impact of increasing earnings per share. However, share buybacks give companies a lot more flexibility than dividends. When you pay out a dividend, there's an expectation that you're going to maintain and hopefully increase that dividend over time. Companies are not as likely to take on that obligation. They don't want to have to be restricted or by investor expectations to regularly increase their dividends if they have other uses for capital that might then turn that positive of paying the dividend into a negative, because they need to borrow money now to make an acquisition instead of paying for it out of cash. With low interest rates, it's a little bit less of a concern. Companies can borrow to pay their dividend. We're seeing that in the pandemic, as up to 25% of S&P 500 companies were cut or suspended their dividend. So a lot of them were able to borrow money at a very low rate, call in their credit lines, and use their revolving credit facilities to cover the dividend. In which case the payout ratio would be greater than 100%. They're not earning enough to pay out their dividends right now. But this is, I think this is interesting because you've got to be wary of pundits talking about dividend investing strategies using older paradigms, and the newer paradigms are that it's much more difficult to rely on dividends as a significant portion of portfolio return, especially if you're focused on the long term and focused on capital appreciation. There are some pros and cons of dividends. On the pro side, companies that pay dividends regularly over time have to be profitable. If they don't have enough cash, if they're not earning enough cash, the dividend can be threatened. Companies that pay dividends tend to perform better during inflationary periods. So if we have high inflation, or if inflation starts to jump up a little bit, those companies would perform better. And generally, companies that pay dividends are less volatile than other stocks. They tend to be large cap, slower growth companies in many cases, and that decreases the volatility. On the con side, focusing on dividends often takes you away from companies that are in growth industries or direct you towards companies that are in the mature stage of their growth cycle, their company life cycle. And that can be detrimental to your long-term returns. This is a big problem that I see with a lot of investment club portfolios, that the clubs are focusing on brand name, large cap stocks, consumer-facing businesses, which often don't have enough growth over the long term to help those clubs outperform the broader market averages. Often when companies are paying dividends or initiating dividends, I see it as something of a negative, because it can mean they're out of ideas how to use their cash. They're generating a lot of cash, they've got a lot of retained earnings, and they don't know what to do with it. They have no growth ideas, they have no acquisition ideas, and so they start to pay dividends because you don't want to sit on a lot of cash that's not working for investors and for the shareholders and for the companies. Dividend income is taxed at a higher rate than capital gains for most taxpayers. There is still a qualified dividend rate, but it phases out for anyone with income, or ordinary income above, say, $40,000 a year. So for many taxpayers, they're going to be paying taxes on dividends at a higher rate than capital gains. High-yielding stocks are often riskier. Whenever you're seeing dividends that are very high relative to savings rates, for instance, those are often more risky investment opportunities. So we'll see people talking about 9, 10, 12% dividend yields. Those rates are often at risk. Those companies are not likely to sustain that over the longer term. When you're outside of common stocks directly, when you look at yields that are very high for master limited partnerships and other sorts of income vehicles, you have to be very careful as well, because often the yields include returns of capital. So they're giving back part of your investment and calling it a distribution, and that distribution yield can be very high. But if I'm just giving back your money, that's not income to you. So you got to be careful with those types of securities. But for common stocks, high-yielding stocks are often a risky sign. And we looked at this a couple of months ago with Toolkit and the Better Investing / Morningstar data service, where the indicated dividend is based on the last dividend that was paid If the company had announced that the dividend was cut, the indicated dividend was still reflecting the old rate. And so it was something you needed to watch out for and something you should continue to review, especially as companies are restoring dividends now or either fully or partly. So when you're looking at the indicated dividend component, you want to make sure if companies have cut the dividend that the indicated dividend isn't is right in the data in your toolkit or SSG Plus. More than, as I mentioned, more than 25% of S&P 500 companies cut or suspended their dividend during the pandemic. So that is always a risk that you have to consider. Again, I think that our growth strategy focusing on quality companies eliminates the risk for many businesses, but not all. And so we've had certainly had some high quality companies like Disney that have cut their dividend, that was never something that most shareholders would have ever suspected to happen. So when you're focusing on dividends alone, here are just some of the pros and the cons. However, I think there are some ways that we can use dividends and the companies that pay dividends in our stock selection. As I mentioned before, high dividends should be viewed with skepticism, particularly right now if a company is seeing its share price significantly depressed. The yield is going to be a little higher, but you need to focus on the ability of the company to rebound, how long that recovery may take. And again, that to me is a big gray area. But instead of focusing on the yield, a lot of investors will look at the growth of dividends over time. You can turn on the display of annual dividends on the SSG in the visual analysis and toolkit or in the SSG Plus. And again, so if you see that dividends have been increasing more or less over time, that's a good sign that companies are in a stable place with respect to the quality of their balance sheet and they're able and willing to increase their dividend over time. You often see that with utility companies, and that can be something that can tip the scales in favor of one utility over another by focusing on dividends. But for our growth stock approach, we're not often looking at dividends. Make sure the payout ratio is not excessively high compared to peers and industry averages. The payout ratio is something that is definitely relevant to the particular industry group. As I mentioned, utilities often have a very high payout ratio. They're paying out a lot of their earnings as dividends. Real estate investment trusts, when you're looking at the payout ratio of dividends related to earnings, will often be more than 100%. But if you look at it on a funds from operations basis, then you'll see those payout ratios reflecting how much of the cash they took in, the funds they received, they were paying out as dividends, so they are sustainable. That's just a little wrinkle when you're looking at REITs using earnings instead of funds from operations per share. But that comparison can be really useful, helping you consider a company relative to other similar businesses and making that decision about which company you might be selecting. Now, one of the things that I like to do periodically is using mystockprospector.com, which is our screening tool at iClub We have options. You can subscribe on a 1 month or a 3 month or a 6 month basis or an annual basis if you wanted to check it out. It's our screening tool. It allows you to build complex screens looking at long-term fundamental histories of companies. And we're using that 10-year history, which is not something you'll find at hardly any free or even paid screening tools on the internet to calculate growth rates over the long term. And we have the ability to calculate the dividend growth rate for the company's history up to that 10-year period. So in this screen, essentially, I'm looking for companies paying dividends consistently and increasing them regularly and consistently. So they're not, they're bumping them up on a fairly consistent basis year to year to year, and that the growth rate of the dividends is higher than the 5 and 10-year earnings growth rate. I'll step through the comparison criteria that I'm using here. The first one here is dividend growth. So this is requiring the values that you see here, not necessarily the values that I entered, but the values of the database. So 0.08% dividend growth is the lowest growth rate over the long term of any company in the database. But essentially, I said, show me any company with positive dividend growth, and the R squared of the dividend growth is between 0.8 and 1. So that's saying, again, that when we look at dividends on a 10-year history, they're going to appear as more or less a straight line and not be very variable. We're going to look at dividend payout below 50%. Again, just a way to restrict companies that and make sure they've got enough cash to pay out the dividend coming from earnings. The current dividend, again, that has to pay at least some dividend currently. And again, this would be on an annual basis, so it may not necessarily reflect dividend cuts, but those companies would be weeded out, I think, later on. The current dividend yield, again, at least positive, and the historic 10-year and 5-year growth rates faster than the dividend growth rate, right? So this applies each company's 10-year and 5-year earnings growth to its dividend growth. And so the earnings have to be faster than dividend growth. And that way we're ensuring that even if they're growing dividends at a fast rate, that earnings are growing faster. So that rate is definitely sustainable. And then I eliminated companies on the Canadian exchanges so we can focus on North American companies. So this is the criteria that I developed, and then my results showed 62 stocks out of roughly 8,000 North American companies. I eliminated financial services, and so that accounted for about another 60 companies that I took out of the mix. They're going to pay bank dividends at a slightly higher rate, but I was interested in other companies, and I did find several companies that were covered by the SmallCap Informer or the Investor Advisory Service. In the SmallCap Informer, 3 companies passed the screen that we track: John Bean Technology, JBT, Methode Electronics, MEI, and Winnebago, WGO. The Investor Advisory Service covers DG, Dollar General, Gentex, GNTX, Insperity, NSP, and Nexstar, NXFT. So that was kind of interesting that there were some companies that passed my screen. I'll flip over and I'll show you the screen right now. There's some other companies that had been covered previously in the newsletters but weren't covered currently. And if we we'll sort by sector, you'll see, I may need to re-log in. There we go. Okay. So yep. Let me log back in. And I've saved this screen so I can revisit it later. So dividends growing faster than earnings. Expand the table. We'll sort by sector. And you can see we covered a broad segment of sectors. Basic materials has a handful, communication services, consumer cyclical, only one consumer defensive, only one energy stock, handful of healthcare, many more industrials. There's one REIT that showed up, or 2 REITs rather that showed up. And again, I would discount those until we look at funds from operations per share. Handful of technology and a handful of utilities. So it was pretty interesting that the companies were not all grouped in one sector other than perhaps in industrials. But there are quite a few companies on here that are familiar, but a lot of them are not as broadly followed by investors using the stock selection guide by investment clubs, those using the better investing method. So definitely, if you're interested in dividends and applying dividends, this I think is a much preferred method of considering dividends instead of screening on yield, screening on looking for high income producing stocks. And it's interesting, there are newsletters as well that you can subscribe to that focus on consistent paying dividends. S&P has their dividend aristocrats, companies that have paid dividends for 50 years. You can look at those resources. And again, what's interesting is that often there's not a whole lot of overlap between stocks that we cover in the Investor Advisory Services SmallCap Informer with those particular companies. And it just goes to show that you can utilize different strategies to outperform the market. But you want to be consistent in your application of strategy. So with that, I'm going to turn to the Investor Advisory Service and give you a performance update. You may have noticed that the Investor Advisory Service was named to the Hulbert Investment Newsletter Honor Roll for 2020-2021 for the 11th consecutive year. Of course, we're very proud about this because only 3 newsletters made the Hulbert Honor Roll this year. 6 newsletters were on the Honor Roll last year, including the Investor Advisory Service. And of those 3 newsletters, only 1 has been on the Hulbert Honor Roll for 11 years, as we have been. The other one has been on the Honor Roll for 5 of the last 11 years, and not consistently. So our performance has been exemplary. Hulbert, you may be familiar with Mark Hulbert, who for many years published the Hulbert Financial Digest. He can discontinue that a few years ago, or it was purchased by Dow Jones. They discontinued it. He continues to operate a website at hulbertratings.com, where he tracks the performance of several hundred stock newsletters. He's offering essentially a service that audits the results. So we do pay for him to audit our results and provide that verified third-party validation of our performance. And you can find it for free as an individual by going to hulbertratings.com, and you can sort through all of the different newsletters for different periods. The honor roll criteria are that the newsletter must outperform each bull and bear market cycle over the long term, typically through 6 bull bear market cycles. So the starting period for this year's honor roll is in April of 2000. According to Hulbert's analysis, honor roll recipients are the most consistent performers of all stock newsletters. They go up more in bull markets, go down less than the market in bear markets. So they're not outperforming during, or they're not always moving, have positive returns during these periods, but they're not performing worse than the broader market. It'd be very difficult to have a newsletter that was able to consistently deliver positive results in bull and bear market cycles, although a lot of newsletter publishers would like you to believe that that's possible. Evidence shows that there's nobody who can do it. But what's interesting about the honor roll, according to Mark Hulbert, is that the recipients of the honor roll, those who are able to outperform over the longer term, provide a less bumpy ride than newsletters that run hot and cold. And it's the same thing. You'll see the same phenomena with mutual funds. In a particular year, perhaps the Brazil Emerging Markets Fund will be up 65%. And so a lot of capital goes into those newsletters. And the next year, they're down 40% because it's just very difficult, 1, to deploy all that additional capital, and 2, the market conditions are completely different. Now, if you looked at that and said, well, I want an emerging markets fund that's able to generate returns above the emerging markets index that I'm tracking over the longer term, then you're going to have a much less bumpy ride. You're not going to get the huge thrills of large gains, but you will at least outperform that underlying index. But beyond that, Hulbert's findings are that the newsletters that are on the honor roll outperform on an annual basis those newsletters that are not on average. and that pattern he's discerned since the mid-1990s. Here are the three honor roll recipients for the 2020-2021 Hulbert Honor Roll. The investment reporter had the highest gain, since annualized gain since April 2000, 10.95%. The investor advisory service was second, 10.48%, and then Bob Brinker's market timer at 8.14%. The investment reporter more fundamental focus, like the investor advisory service. As I said, they've only been on the honor roll for 5 years. Bob Brinker's market timer and IAS have been on it for 11 consecutive years. So that 10.4% return of IAS, when you compare it to the comparable return of the Wilshire 5000 during that period of 6.06%, really gives you a sense of how strong that performance is. And there are a lot of investors who think, well, gosh, 10% return is not very exciting. But if you were in an index fund in that same period, you would have a return that was 40% lower than the return from the investor advisory service. And when you compound that return over time, you can really generate significant outperformance. When you look at the investor advisory service long-term performance, here we are as of November 30th for the 1, 3, 5, 10, 15, and 20-year periods. The IS is in green, the Wilshire 5000 is in the orangish color. You can see we've outperformed each of those segments. We have been updating our performance on the investor advisory service website on a more or less monthly basis, using the Hulbert data, so you can visit it at any point and take a look at how the returns have been going. We tend to focus on our 10, 15, 20-year returns because we are a long-term focused newsletter. We don't expect to outperform the market in a year-to-date or a 1-year period necessarily, because our picks are focused on taking advantage of mispricing over the longer term. When we look, Hulbert started tracking the investor advisory service in 1995, the beginning of 1996. And this is the annualized rate of return. Since then, 12.6% compared to 9.5% for the broader market. And if you think about the longer term annualized rate of return of the broader market, the S&P 500 and the Wilshire 5000, close to 10%. If we're at 12.6%, that's a pretty significant outperformance level, and nothing that should be kind of brushed aside. It's a pretty remarkable accomplishment. So I'm very pleased with the team for the results that they are able to generate and continue to generate even during tough markets. According to Mark Hulbert, the most important reason to pay attention to the newsletter honor roll, in my opinion, it helps you steer clear of particularly risky services that, even though they may produce stellar long-term returns, require more intestinal fortitude to follow than most investors possess. So there could be newsletters that have phenomenal track records, but they have huge swings in their performance, and that's very difficult for investors when you're looking at the returns and you're looking at your portfolio and you're seeing it. The value of your portfolio decline, and a lot of investors start to get scared, start to get nervous, and sell out or stop following the strategy during those periods. And so if your results are a little more consistent, it can make it easier to follow. And that's one of the key advantages of the honor roll. If you are not a subscriber and you want to take advantage of it, if you're a Better Investing member, check out the Better Investing member price on the Better Investing website after you log in. If not, you can use the promo code 11 for 11 at investoradvisoryservice.com before the end of the year and subscribe at a pretty good discounted rate there. So I invite you to check that out. Once again, we're very pleased with that investor advisory service performance. So I wanted to close out our session today and take a look at a stock to study. The stock is Simpson Manufacturing. founded in 1956 and headquartered in California. The ticker symbol is SSD. They're a business in the construction products company. They make wood construction products like connectors, truss plates, fastening systems, fasteners used in light frame construction, and concrete products, including adhesives, drill bits, materials and repair products for use in concrete masonry and steel construction. They moved from the S&P SmallCap 600 to the S&P MidCap 400 in October. Revenues were up 17.5% to 364.3 million rather in the third quarter. They were able to bring back Lowe's as a customer, the home improvement store, and so that helped boost results in the quarter. But earnings were up 58.8% to $1.54. This year during the pandemic, when you have so many people at home, they're looking around. They're not taking their vacations. They're looking around at the state of their home, and remodeling is on a huge upswing. New home construction is still on a huge swing, and that's really helped, I think, boost Simpson's results for this year. But they've been on a long-term growth trend when you look at their history, which we will in a couple of minutes. But right now, there are significant shortages of building products. Lumber is very expensive relative to history because there's such demand. There are shortages, and that's inhibiting current growth of many companies. Even though they've been performing well, there's still more demand. But that's helped to boost prices, and that's one of the reasons that you see earnings increasing faster than sales, as you're able to maximize the margin. The addressable market for their products is estimated at $3.5 billion, and they're just over $1 billion in sales themselves, so they've got plenty of room for growth. They have a software system that aids in truss construction, and those builders who use their software are big customers, and so they want to continue to roll out that truss design studio to get more people using it, more potential customers using it, which will help. They are working on increasing higher margin product sales in their concrete line, and they're expanding their business in Europe. So there are some key drivers for their business that we're looking at. When we look at the history here, it is the growth has not been as fast as some other businesses, but you can see a lot of consistency there, at least coming out of the last recession, pretty much on an uptick on an annualized basis for sales, as well as for earnings, a little bit of a slowdown in 2012. The historical sales growth rate since 2010, 8.3%, earnings up 15.2% on the strength of some good margin expansion. And when you look at the analyst estimates going forward and the uptick for the first 3 quarters of the year, looking pretty good. We focused on this in the SmallCap Informer, and our estimated sales growth rate is 8%, and our earnings growth rate at 9%. I think earnings growth will be a little bit faster than that based on continued margin improvement. Again, we're just being conservative, expecting that after the current building boom, things will cool down a little bit going forward, but I still think this is a pretty interesting business and an interesting time to be in it. Here is the quarterly percentage pre-tax profit, so the profit margin on a trailing 12-month basis going back to 2016. So you again, good 15% plus margins, which is pretty good in the construction business. And that trend, that trailing 12-month trend, has been in place for more than a year, taking it up to closer to 18%. Pretty substantial margin improvement that then you'll see for many companies. On the PE ratio side, that PE ratio has been pretty consistent. On the high side between 26 and 29. On the low side, it's been as high as 22, but I've struck those out to be a little conservative. And so PE low on the low side, 16, 17, 18 has been the low PE. Current PE at 21, so well off the high PE ratio, well off the average PE ratio, which is closer to 22. And the payout, you can see there, slight yield, but they're still only paying out roughly 30% in the last fiscal year. And that pay ratio has been going down even though as they've been increasing the dividend. So that's good. They've got room to increase the dividend a little bit higher if they would like to. On the reward to risk side, if we look at their high PE of 27.8, which I think is possible, times high earnings of 650, gets us to $180 from $90 where they are right now. So that's a doubling in price on the low PE side, low PE of 17. And earnings of 422 from the trailing 12 months gets you to a low price of 73 from the current price of 90. So that's a reasonable downside. Puts it in the buy with a 5.4 to 1 upside downside ratio, buy below 100. So a little bit room left to get into the stock. That average percentage payout, I think, is a little maybe a little high, as the company has been paying out less of its earnings, but adds a little bit of a yield. 1% current yield gets you to a 16.2% percent annualized rate of total return. I think there is some additional upside from that particular company. Joe says he's used their SSD products and liked them. They're needed to comply with tornado compliance code. So that's interesting, those fasteners, shear wall systems, etc. So that's one big benefit of Simpson Manufacturing. I would assume as well that revised building codes in hurricane-prone areas are also, going to have to follow those same sorts of building code revisions that would require some additional use of Simpson products. This is during the pandemic and the recession. Home sales, home building, home improvement have been all been performing really well, those companies, and that's slightly counterintuitive and slightly against the historical trend. Usually during a recession, we see housing starts start to taper off, but it's been the nature of this recession that people are spending time at home and going, gosh, if I'm going to be working from home now, maybe it's better if we get a bigger house where there's room for mom and for dad to have their separate workspaces. Kids are going to be at home part-time or more, so then we want to have a space for them as well. So it's been, I think that's helped kind of help some of those trends. So I think that there's a longer term good prospects for Simpson, but I would again be watchful on the downside if things start to deteriorate further in the economy. There could be a period where Simpson sales would start to drop off fairly considerably, and then that would impact the company. But again, over the long term, I still think the prospects are pretty good. Okay, some questions here. Bruce says, any thoughts on Sprouts? Ticker is SFM. I have looked at Sprouts in the past. I'll follow up, fire up my toolkit here. We'll take a look really quickly. And I've never been so enamored of it that I thought, oh, this is a good opportunity. It's either been too expensive. So if I take a look at this company this way and kind of restrict to the last 6 or 7 years, $5.5 billion in sales. They've had an upturn this year again, as people have not eating out. Grocery stores have done very well this year. More people buying from grocery stores as part of their regular routine. Analyst estimates of growth around 12%. So let's say 12% sales and earnings growth. You can see that one of the problems with this company is just there is the investor sentiment is very, very, very has been diminished. It's pretty low. So those prices have gone down, even though the company has kind of seen its performance do pretty well. And so, got to keep that in mind. Even if you're right, if everyone else in the market doesn't think you're right, that can be a problem. Sales up 9.5%, earnings up 138% in the quarter. Margins, this might be part of the problem. Margins have been seriously deteriorating from a high of 6% down to 3.5%. 3.5% is still fine for many grocery stores. 6% was exceptional, but for whatever reason, the margins have been declining, and so that's part of the problem, I think. If I just kind of knock off quick and dirty analysis here, looking at the current PE ratio of 9, it's been as high as 13 in the last 52 weeks. It's been as low as 6. Will it get back to 22? That would be a big jump up from the current PE ratio of 9. And is that possible? Not really sure. If you thought it was possible, the stock could be a really good bargain right now, but the market is saying that's not likely to happen with that high PE of 13. Let's just say, for the sake of argument, that the highest the stock PE will go is 13, and they'll go as low as, we'll split the difference between the current PE and the low PE 9, and so something close to 8. And where does that get us in terms of, puts it right in the, roughly, in the buy zone. So if you did a little deeper dive into Sprouts and thought that this was kind of met your requirements, there might be some opportunity there. I would want to know what investors are seeing and how they're reacting to this decline in margins, what the company says about that, and also just the fact that the PE ratio has been so low in the last 52 weeks. What does that mean? It's not been as high. If we look at we'll look at the graph here. This 2013 distorts the graph, so it's hard to see those trends, but we do see they've been coming down every single year. The PE ratio is getting lower and lower and lower and lower. And so 2020 looks like it'll be somewhere between 13 and 6. So that's a pretty steep deterioration of PE ratios. So take a look at those. Al also mentions that Simpson, Al's been in the construction industry for 45 years, and Simpson has always been top-notch and widely used in residential as well as commercial uses. So again, that's good. That was my consensus when we looked at it as well. That I thought they had good standing in the industry, which we like quite a bit. Becky said, I said to avoid COVID-affected companies. I've accumulated Delta over the last few months, and it's done quite well. Again, yes, that's fine. Delta, I think is the best of the major airlines, just in terms of management. But they're still begging companies to take leaves, unpaid leaves, and there are more cutbacks on the way. It's clear that I don't think that we're going to see 2019 levels of air travel until 2022, 2023. I think there's going to be a long, slow recovery for the airline industry, even after we reach herd immunity, if that happens in the U.S. But remember that that's not going to, what happens in the U.S. is not what's going to happen in other regions around the world. And I think that's going to continue to hold back a lot of airline stocks, So I would still manage to the downside for many of those particular companies. Bonnie says, what about Disney's yield right now? I don't know what Disney's yield is right now. This is a new stock study, and the indicated dividends are $1.76, and I don't think that is correct, but yeah, especially since unless they've restored significantly all of their dividend. Their fourth quarter ended September 30th. They only had dividends of 88 cents that were paid, so they were cut in half. And the current yield is showing an indicated yield of well, we have to do the stock analysis, but based on that 2019 level of $1.76. So again, I think you have to take it and consider it pretty carefully as you're going there. Becky says back to slide 7 real quickly. So let's jump to back to slide 7. Nope, not that slide. You're asking about the dividends of total return, I believe, and section number 2 is the PE ratio expansion. Yes, that does result in capital appreciation, but capital appreciation is driven by over the long term. Capital appreciation is driven by earnings, right? So a company has to make profits in order for its share price to go up to drive capital appreciation. And so we equate every percentage point of earnings growth equates to a percentage point of price growth over the long term. In the short term, things go all over the place. But if a company is able to grow its earnings 10% a year, we would estimate that the company would be able to increase its price 10% a year over the long term. And the P ratio side of it says that, well, if we can buy it when the P ratio is lower, then even if the company grows at 10% a year, we might be able to see a 12 or a 14% rate of return in the short term in a 3 to 5 year period, say, as that P ratio increases. So yes, it's the price, but no, it's not driven by the earnings of the business, and that's what we take a look at. Yeah, Al said, again, Disney did suspend their earnings. They just reported last week, so I'm not sure, what the status of their dividend is right now, and if they have restored it or not. And so again, the data from Better Investing and Stock Central says that they are paying a dividend. And again, I think that's incorrect. I mean, it's just a circumstance that no one ever considered when the data conversion to stock selection guide data from the Morningstar raw feed was developed. And so the caution is, you as an investor need to be aware of that component. If that's 2 or 3% for some company that's cut dividends, and you're looking at that as and saying, well, yeah, it does meet my total return expectations, and that dividend has been cut and may not be restored fully for another couple of years, then your total return formula projection is going to be a little bit below. So Neil's asking about, I don't have any thoughts on the Synex spinoff of Concentric, but I expect that'll be covered in Investor Advisory Service in the January issue. So I would expect that's going to be coming. And the Investor Advisory Service subscribers got an alert about Disney today, just about their report. They're increasing their the Disney Plus monthly fee. And Neil's question is, how much upside is still left with parks still closed and movie releases impacted with continued theater closings? And I think that's exactly my concern with Disney, is that a big chunk of their business is related to theme parks, which again is quite diminished during the pandemic. And again, I think we got to be cautious about projecting when traffic will reach levels again that allow them to be profitable. They're going to have to operate those businesses on a short-term loss basis, because you've got to open the park to get people in, but you won't have enough people coming in necessarily to make every day be a profitable day. So I think that's a big concern. And then the other part of their business is making movies. Yes, the Disney Plus service is there, but again, a lot of people were not paying for their service. There were a lot of promotional offers. Verizon wireless customers, if you were on an unlimited plan, you got a free, 6 months or 1 year or something of Disney Plus without paying monthly fees. So their subscriber numbers were including a lot of people who weren't paying, and the big expensive movies that they were producing that they can't show online, if they include them in the streaming service, even if they have an upcharge to them. Again, it's not nearly as profitable as the old theater business, where you make a movie, you show it in a cinema, people go to it and generates buzz, etc., and then you release it to streaming or DVD at some point down the road. And that model has been inverted, and I don't think it's going to take some time for consumer behavior to normalize around, oh, movies are out and now we've got to pay to see them from our living room, when usually the cost of seeing entertainment in our homes is a hidden cost. It's something we pay once a month as part of our broader service package, so we don't think of the cost in the same way as paying on a per event basis. That model has worked for sporting events, boxing, ultimate fighting, etc. But on an entertainment basis for movies, that's been much less common. So again, for me, that's a big consideration with Disney that I think a lot of investors are glossing over, and I think that would be something you need to really consider as you're going forward, understanding what the upside and the downside really is for that particular business. Well, with that, we will say so long to all of you for 2020. We'll look forward to seeing you in 2021 with a whole new year ahead of us. We'll try to continue to generate content and bring it to you. In the meantime, keep calm, stay the course through the next few months. I think hopefully we're at the tail end of a terrible period in American history with the pandemic, and my condolences to those of you who have lost friends and family to this pandemic. Please stay healthy yourselves, and we'll look forward at seeing you in 2021 at our next Lunchtime Stock Club webinar. Thanks so much.